Very good evening and warm welcome to the 32nd webinar of ICFAI's WiseViews interactive webinar series. Ladies and gentlemen, we have been holding these webinars every Friday evening at around 7:30 p.m. without any interruption. And today it is the 32nd webinar and we have a very interesting guest with us, Mr. Nilesh Shah. Mr. Nilesh Shah is the founder and CEO of Envision Capital. Please join me in welcoming Mr. Nilesh Shah to this webinar. We are extremely happy at ICFAI to see you and welcome you and include you as part of these leadership conversations. As I mentioned, these conversations are held each Friday at 7:30 p.m. and we're extremely fortunate that you are with us on the 32nd webinar. We are also joined by a large number of professionals from across the country, from various walks of life. We have some distinguished professors from ICFAI joining this session, and my esteemed colleague, Prof. Prasad, also has joined. Welcome to everyone. I'll wait for Mr. Nilesh to join back, and then I'll start the introduction. So in the meantime, ladies and gentlemen, I wanted to ask one question to you, that is it more convenient for you to attend these webinar series at 7:30 p.m. on Friday or 6:30 p.m. Probably you can send in your response on chat message. We will consider that for the next round of sessions. But we are experimenting with 7:30, thinking that it is more convenient to some of you who are working from offices. So you will get back home after your office work, and thought will make it a little more easier for you to join. However, do let us know in the chat box. We will also wait for Mr. Nilesh Shah to join. Dr. Bhaskar Rao Garu has helped immensely in talking to Mr. Nilesh Shah. Thank you very much and welcome Dr. Bhaskar Rao Garu to this webinar. I think you have put together a lot of work and also interacted with him, and it was like easy for us to gather the topic and also collect other details to make sure that this is happening today. Welcome back, Mr. Nilesh Shah.
Thank you. Sorry, apologies. I think there was some problem at my end. So yeah.
No problem. No problem at all. We are very happy. We are very happy because prima facie, you are an alumnus of ICFAI, and we are extremely proud to host you on this leadership series. That's what I was mentioning and sharing with the audience. Today, we will have roughly about an hour or hour plus discussion, and most of it will keep it interactive as desired by the audience as well as desired by the speaker himself. So ladies and gentlemen, allow me to introduce the guest, and very quickly after that we will get on to, so the topic today is investing in India, new investment opportunities and game changers. Mr. Nilesh Shah is very much here with us. So we have allocated about 20 minutes of the initial remarks and opening session by Mr. Nilesh Shah, followed by 40 or 40 plus minutes of interaction based on the Q&A. The questions are already keyed in by various participants at the time of registration, and a few more questions will be picked up as the conversation moves on. We'll look at the chat boxes and gather those inputs as well. So I take pride in introducing our alumnus, Mr. Nilesh Shah. Mr. Nilesh Shah holds a CFA from the ICFAI, where he ranked all India first in CFA preliminary levels, and a PG program in management from the prestigious Arima, where he was valedictorian. Valedictorian means he got the highest academic grades out there, and he also probably would have delivered the valedictory speech during the convocation. An early part of his career, Mr. Nilesh was with Kotak Group for 13 years. He joined in 1994, and by 2005, he became the youngest member of the Kotak leadership team, comprising of the firm's top 30 employees. Prior to asset management, he spent 8 years in corporate finance at Kotak as well as at HDFC Group. He has been awarded the Achiever Award by JCs, a very popular global youth organization, which is now spread across more than 100 countries. In 2011, he was invited by the Columbia Business School as a speaker on investing, finding value in India. The distinguished guest is now the founder and CEO of Envision Capital and the portfolio manager of India Value Portfolio. He has all in all about 29 years of rich experience in corporate finance and asset management. Prior to Envision, Mr. Nilesh was the president of Kotak Mahindra Asset Management. He held this position where he led the investment team that was responsible for managing and advising equity assets worth 1.2 billion USD. During this period, Kotak Asset Management received several awards and was ranked as one of the most successful asset management firms in India. He spearheaded the investment team that was responsible for advising the Kotak India Mid Cap Fund. He also managed several equity portfolios that delivered substantial outperformance through bottom-up stock picking. So, ladies and gentlemen, with these initial few remarks, I once again welcome our distinguished guests. To start the conversation, I once again welcome all of you. Please actively participate by muting your mics, and we'll pay all the attention and we'll listen to the speaker we have today with us. Once again, I'll thank Dr. Bhaskar Rao Garu for helping us in getting this wonderful guest this evening for us. So Mr. Nilesh Shah, over to you.
Thank you so much. Well, thank you so much for that lovely introduction. This is essentially the last day of the week, and it's like really the fag end of the week, the last hour. And so I'm quite sure that everybody's had a hectic week, but we'll try and make this session as interactive as possible. And of course, interesting in the process. And it's a wonderful feeling to come back to my alma mater here, ICFAI. Little did I know that several years back when I completed my CFA, that I would one day be there to basically be able to address, I come back to the alma mater and be able to kind of address a larger audience. So it's a wonderful feeling. It's a feeling of homecoming. The topic today is very, very interesting because it talks about new opportunities of investing or new investment opportunities. And I'd probably say that maybe the topic could have been even titled as New Investment Opportunities for New Investors in a New India. That to me is probably the most, in a way, the appropriate topic. And I will spend, the next few minutes talking about what my perspectives are in terms of how India is becoming an attractive investment destination. India turned 75 in terms of having achieved its independence 75 years back. So to that extent, you could say that isn't it been too long? But at 75, India is both young and agile. What I mean by this is that we are just probably stepping into the most exciting phase of growth for India in the years and the decades ahead. And what makes this so interesting? Because there is probably no other large economy in the world today, which is still kind of yet a sub-middle income economy and has the size of a $3 trillion economy. So the starting point is that India is almost a $3 trillion economy, a population of 1.4 billion people, and a per capita of just $2,000. This itself is very, very powerful because the journey ahead over the next 10, 20 years is all about India moving from being a $2,000 economy to becoming someday a $10,000 economy in terms of per capita. And in the process, of course, we have set an intermittent milestone of getting from $3 trillion to $5 trillion, and eventually $10 trillion over the foreseeable future. And that makes the entire growth journey very, very exciting. And this, therefore, is going to create huge amount of investment opportunities which I think are going to represent scale and attractiveness for investors. And the way I look at this is that if you look at where China has come in the last 20, 30, 40 years, and China too has traveled this journey from $2,000 per capita to $10,000 per capita. And this was again triggered by a large mass of population and massive reforms which attracted investments. And China was a huge recipient of not just its domestic investments, but also foreign direct investments and investments coming into different areas. And it's quite possible that over the next 10, 20, 30 years, we are going to see what China witnessed between 1975 to 2015, 2020, and what the United States witnessed between post the World War II from 1950 all the way up to 1990 and even beyond. And to begin with, I'd say that there are 3 Ds which are going to define the investment landscape of India. First, of course, the first D is demographics. The fact that India has got 1.4 billion people and a population which is still very young, majority of the population which is below the age of 30 and whose incomes are increasing, affordability is rising, awareness is increasing, and most importantly of aspirations are increasing. And therefore, India's attractive demographics makes India a very unique structural growth opportunity, an opportunity which is unparalleled today. No other part of the world today represents this kind of a mass of population and therefore consumers. And therefore, you're going to see over the next 5, 10, 15, 20 years, different kinds of consumer-oriented businesses become very attractive investment opportunities. Not just in terms of consumer staples, but consumer appliances. If you look at, for example, in India, the largest kitchen appliances company, for example, has a revenue of about 2,000, 2,500 crores. It's not even $1 billion company in terms of revenues, just 2,000, 2,500 crores. Now imagine in a country where we have 250 million households, that's 25 crore households, the average spending per household every year on kitchen appliances, something as basic as kitchen appliances, is just 100 rupees. That number could potentially be from 100 rupees, go to 1,000 rupees in the next 10 years, and that creates a 10x opportunity. That is just an illustration. So it's consumer staples, consumer appliances, hospitality, travel, discretionary spending. These are things which are going to basically become significantly big over the next, again, 10, 20 years. For example, in a country like India, we have, in a country of 1.4 billion people, there are about 500 million people who travel by train every year. Now, versus that, airlines, pre-COVID, was just 140, 150 million people. In the next 10 years, even if that industry grows at a rate faster than the broader GDP growth rate, we would potentially have 700, 800 million people flying annually, with the 80 to 100 odd new airports coming up, several new airlines coming in, with Air India getting privatized. Air travel is going to witness huge amount of growth. And therefore, imagine what the aviation industry is going to become. And therefore, all those kind of businesses which are essentially into airline bookings are going to see businesses grow maybe 5x, 10x again over the next maybe 8 to 10 years. And along with that will be the growth of hospitality, hotels, stays. These are kind of businesses which are going to grow exponentially. So I clearly believe that it's essentially going to be a lot of these kind of businesses which will grow. The second big powerful theme which is there is essentially the businesses around digitization, the second D. Technology is becoming extremely powerful. And while technology has played a key role in rest of the world, which has been able to create technology, I think India has been a tremendous adopter of technology, which is creating several technology-led, digital-led businesses in India. And that's pushing a lot of businesses to kind of grow and expand. So before 2016, before 2015, I'd say before 5, 6 years back, if you wanted to basically create a pan-India business, it would have taken you 10, 20 years to do that, because India is such a large country, such a heterogeneous market. Markets are changing every 100 kilometers that we travel in India, but technology has been a huge unifying force. So what started off with Aadhaar And then, of course, it went into basically Reliance launching geo services and making data so affordable. Today, we've seen that spending on data is growing, digital adoption is increasing. COVID fast forwarded a lot of all of that. And that in turn created a huge opportunity. So I think clearly digitization is driving that business. We're currently seeing a huge amount of IPOs out there in that space, businesses which have got pushed forward because of technology. And that I think is driving and creating a lot of investment opportunities. And of course, within that, investing into startups, venture capital investing, private equity investment itself is creating the opportunity. The third D, which I would say is very interesting again, is decarbonization. That I think we all owe it to our future generations to ensure that we invest progressively to make India completely carbon neutral. And therefore, decarbonization is going to become an extremely important investment theme. Therefore, investments into renewables, investment into any of the other cleaner technologies is again becoming an attractive investment opportunity going forward. And therefore, apart from renewables, but anything which ensures that there is a lot more efficiency in terms of how we consume energy, I think is going to become a big catalyst for attracting investments. So clearly it is these 3 Ds which essentially are going to become the core pillars of investment opportunities in India, which is our demographics, our digitization and adopting digital technology to grow businesses, and decarbonization. And I think what we're going to basically see going forward is that all of this essentially is going to bring in a whole new set of investors. Again, I bring to the fact that we have 140 crore people, but of which less than 10 crore people actually have a demat account. Less than 5 crore people have a mutual fund account, a unique mutual fund account. A spending on general and health insurance is just $20 per capita. If you look at it, rest of the world averages $400, which means a gap of 20x between what we spend on general and health insurance versus what the rest of the world spends. So that again is going to create a huge investment opportunity. And with the adoption of technology, you're going to see investors being able to spot opportunities and make those investments in a very, very effective way. So clearly, I clearly believe that next 10 to 20 years, India will and has the strongest chance of emerging to be a very, very strong and a very attractive investment destination as the economy powers ahead and as India emerges to be the world's fastest growing large economy and changing from being a $2.5 trillion economy to a $5 trillion economy and then to a $10 trillion economy. We're going to see extremely attractive investment opportunities across several consumer businesses, financials, across infrastructure, precision manufacturing, healthcare, technology. All of these kind of businesses are going to emerge very, very strong investment opportunities. And these opportunities will come across equities, be it publicly listed companies, be it IPOs, be it private equity, growth investing, venture capital investing, real estate, fixed income. I think all of these kind of opportunities look extremely attractive. And therefore, I think I am extremely excited about the prospects ahead and the kind of opportunities which India offers for investors going forward. So I'll kind of, in a way, end this introductory kind of perspective, and we can kind of now make this a lot more interactive.
Thank you, Mr. Nilesh Shah. That's a fantastic and optimistic pitch about the India growth story in your own words and in your great style. I'm quite impressed and I'm quite proud of you that you have made this pitch on 3 very important dimensions, and you call it 3Ds. The demographics, where there is a rising aspiration, growing awareness, and also increasing affordability. And therefore, the customer-centric, consumer-oriented businesses will actually have a field day in the years to come. And that's a very, very positive note. And the second D has been about digitization, digital technologies, that is pushing forward various businesses by deploying technology and the immense opportunities that are available to us. And the third and the most important thing is the clean technologies in terms of decarbonization, renewables, and so on and so forth. I think that's a very, very important conscious way forward aspiration that you have put forth for our growth map. And I think you have also identified various gaps where we are less than 10 crore demat accounts, very few mutual fund accounts compared to various other countries. Probably you said general insurance and health insurance are spending per capita is less than $20. I think the others are at $400 per capita. I think that's a huge gap, and there's a huge opportunity for various businesses and investments to come into India. So in simple language, we have to look forward to the new opportunities in the new India in the manner that you have pitched, and therefore there's a great deal of promise for all of us. Now, without much ado, what I will do is I will request Professor R. Prasad to join in. Professor R. Prasad is the Director for Academic Wing at ICFAI Group. He's currently heading the latest program called Online MBA program. It's a fully online MBA. He has architected the program, and he's a professor and mentor for the program. Professor R. Prasad is from the industry, he's from the academics, he's from the world of entrepreneurship altogether. He has roughly about 30 years of rich experience and exposure. He graduated from IIT Bombay and IIM Kolkata, and I'm extremely proud of sharing the screen space with both the luminaries here this evening. Over to you, Professor Prasad.
Thank you very much, Professor Rao. It is indeed a lot of inspiration and excitement which has come in from the initial presentation to Summit, moving from 2,000 USD to 10,000 USD per capita, driven by aspiration and youth, and waiting for a lot of investment. I'm also happy that we are adhering to the 3 Ds in terms of demographics, digitization, as well as decarbonization. I'll very quickly move over to the questions. We have clustered it. We've taken a lot of respondents have posted their questions. So we have curated it and clustered it. So this is the first cluster, and this is the first question in that cluster. Where should new investments come in for India to be a world leader on GDP? And the more important subpart, while managing its income inequality?
Well, clearly the biggest area, which is of course currently a huge deficit, but simultaneously a huge opportunity, I clearly believe is the infrastructure space. Infrastructure, I think, is imperative for India to become competitive. Clearly, there's a huge talk about a China Plus strategy. There's a huge talk about the Go East strategy. And clearly, of course, India with its large market and a large pool of labor is a very, very attractive manufacturing destination. But the big challenge for the manufacturing sector has been the relatively high cost of capital, the high cost of power, which is energy, and the high transportation costs. Of course, because of several initiatives, cost of capital has come down, interest rates are low. But one big area where we still have a long way to go is infrastructure, be it in terms of having world-class network of roads, rails, air transport, power, energy. I think clearly a huge amount of investments are required. And if India has to achieve its aspiration of becoming a $5 to $10 trillion economy and to become a very large manufacturing hub, infrastructure is one large area where several hundred billions of dollars can actually come in. In addition to all of this, the government itself has unveiled a national asset monetization program where a lot of unutilized assets will be essentially be up for sale, where large global investors can come in and own these assets and operate these assets. And these essentially can attract several hundreds of billions of dollars. It can unlock these idle assets and at the same time create jobs for millions of individuals in India. And so clearly, if there is one big area where we can attract huge amount of investments, that in my mind is clearly the infrastructure sector of India.
Thank you. The other part of the question was about how do we reduce the inequality while doing this growth?
Well, so today the big challenge that we face is that on one hand, we have a very large mass of population which is still dependent on agriculture and on the farm sector. So it is estimated that the farm sector employs or basically about 50 to 60% of India's population is dependent on agriculture for incomes. But agriculture contributes to just about 15 to 18% of the GDP, which means that the per capita income of people who are dependent on farms is way below the national average of $2,000. And what we are going to see over a period of time with increasing education levels, increasing literacy levels, the inclination of the younger generation to continue to work on farms is going to keep declining with every passing day and with every passage of time. And therefore, it's important that we are able to create the shift from farms to factories, which doesn't mean that we leave our farms unattended. It doesn't mean that we leave our farms vulnerable to the vagaries of weather. It means that in farms, we employ more science, more technology, more mechanization, such that farm incomes go up. And at the same time, we create livelihoods of these families who are dependent on farms and create adequate livelihoods for them from the manufacturing sector. And I think for us to have a very large and a very competitive and a vibrant manufacturing sector, I think it's important that we essentially invite investments into infrastructure, create world-class infrastructure to create a solid backup for our factories. And I think in the process, we will be achieving several objectives, which is to create livelihoods, to increase incomes for millions of our fellow Indians who are working on the farms. And so clearly, in a way, we can invite investments, trigger economic activity, raise livelihoods, and reduce inequality of income and narrow the gap and ensure that more and more people come out of the poverty line, come above the poverty line, and are entitled to a very, very meaningful livelihood the way all of us have.
Thank you. I think there is a very specific roadmap there, and which perhaps entrepreneurs will be able to follow. And I think that is about agriculture moving to manufacturing enabled by infrastructure. We move to the next question. Looking at the data on people who have demat accounts, mutual funds. One of the questions was why new investment opportunities are still not able to build the trust which things like fixed deposits and gold give to common people.
So, well, we have to keep in mind that essentially fixed income. I will not put gold here because gold, according to me, is as speculative and has honestly no economic value. Fixed income essentially is pretty much like a rental income that you essentially park your capital, you get a fixed return on it, and the upside is completely defined, which is that if you're putting your money into a bank fixed deposit, you get between 5 to 7%, and that's about it. There is no upside beyond that. And therefore, there is no expected downside to it. So it is honestly a product which is in a way safe, relatively safe, and is intended to basically, in a way, take care of the very basic inflation. That's what fixed income is. In a way, it's pretty much guaranteed or contracted returns on your investment. Versus that, equities inherently is capital or it's risk capital, which essentially where the upside is not contracted, it is not guaranteed and is undefined or not defined. But what equities does for you is that basically it is expected, or the purpose of equities is to help you to beat inflation. which means that if inflation rate is 5 to 6% in a particular context, fixed income takes care of 5 to 6%, but equities is expected to kind of deliver returns more than 5 to 6%. Now, what happens is that because equities get publicly traded, which bank fixed deposits do not get, there is going to be volatility. And we need to understand the difference between volatility and risk. Volatility is fluctuations in stock prices, whereas risk is permanent loss of capital or permanent damage to capital. So investing into high quality equities can be volatile because of fluctuation in stock prices, but over a long period of time, the loss of permanent capital or the damage, the permanent damage to capital is hardly there. So if you look at it over 5 years, 8 years, 10 years, 15 years, 20 years, have equities been very rewarding? The answer is yes. And have people lost capital over 5 years, 8 years, 10 years? And even if for that, if I were to take the equity indices, the Nifty or the Sensex as a benchmark, no, there has honestly been over a period of time, it has rewarded you, and it has more than rewarded you. So I clearly believe that that the purpose of both equities and fixed income are very different. Coming to gold, look at it, very interesting. Over the last 20 years, if there is data which shows that we as India, as country, have bought gold. From whom have we bought this gold to? We bought this gold from foreigners because we don't produce enough gold. We import gold, right? And what have we sold in the process to them? And we have bought gold. We've given them money. With that money, what have they done? If they have come into the form of FIIs and bought our equities, they have bought our shares. What have they bought? They've bought very high quality names. And over the last 20 years, those equities have outperformed quite significantly gold. So by buying gold and allowing them to buy equities, we have in a way lost out in the process, because gold has no economic value. It at best is probably a store of value, but it has no value which increases. So to that extent, I clearly believe that I think financial assets essentially are the best opportunity going forward. And within that, we need to have the asset allocation between equities and fixed income, which takes care of inflation, and equities, which gives you returns above the rate of inflation.
Thank you very much. I think that kind of answers the why question. I'm also able to relate it. We have these global entrepreneurship monitor surveys, which keep saying that India has very high confidence when it comes to entrepreneurship, but also rates the fear factor very high. So I was wondering how this behavioral change will take place over the next 10 to 15 years. Any observations?
Well, I think behavior is something which is part of human life. It is part of us as human beings. And honestly, it's something which doesn't change, because fear and greed is pretty much core to our thought process. And therefore, in investing, what is very, very important is to kind of be able to, in a way, so there's of course the information edge, which is the starting point, the analytical edge, which is the ability to process information. And then of course is basically the behavioral edge, which means that how do we as human beings deal with our own thought process and our behavior. And there are two ways to do it. I think the two most successful ways one is to have a very well laid out asset allocation plan, which means that to be very clear that what is the kind of allocation that I want to do to equities, to fixed income. I'm using equities and fixed income as proxies for equities, which have relatively higher risk and higher reward. And of course, fixed income, which have very defined reward and very defined or a very minimal risk. And therefore, to have the asset allocation in place, that I think is very, very important. Number one. Number two is to basically what is called the systematic investment plan, which of course works in mutual funds, where you essentially, in a way, keep investing in tranches to take advantage of the volatility. And I think systematic investment plan is something which you can do not just in mutual funds, you can do that as an investor. And of course, the third aspect to manage behavior is diversification, is to basically understand how important it is to diversify, to understand concentration as a risk. We all can get too carried away in saying, is, you know what, this is a great, interesting IPO. I'm going to put all my savings in this IPO. Or this is a great equity idea or a great stock. I'm going to put all my money into that. We have to be very, very cognizant when we take these kind of decisions, that is it emotion which is overpowering economics of that decision. And therefore, I think that the best way to deal with the challenges of behavior are to have appropriate asset allocation or optimal asset allocation. The second is essentially to do systematic investment plan and to be systematic about your investments. And the third is to understand the nuances and the challenges of diversification versus concentration.
Thank you. I think we have brought a lot of intellect and analytics. And I think that is one way of overcoming the emotion and then getting it a bit more organized than what it is right now. We come to the next question. And this is about what has been the impact of investments on India post-COVID. What are the changes? And are there any impacts on different segments? For example, in retail, there's a lot of talk about mom and pop shops getting affected. So how do you view this?
Well, post-COVID, in a way, what COVID has done and what I alluded to in my introductory remarks and my perspectives, that what COVID has done is essentially it has fast forward the adoption of digital technology. And this adoption of digital technology, if you ask me, is essentially been a big booster for India as an investment destination, because what technology has done is it has essentially helped three constituents of our economy. First of all is the government itself. The second is businesses and enterprises. And the third, of course, is consumers and individuals. In terms of the government, what it has done is that it has helped the government to target its various social and welfare schemes in a more effective manner, to ensure that it is able to identify beneficiaries, eliminate ghost beneficiaries, and ensure that the social welfare schemes reaches the appropriate beneficiaries. And that, to me, I think is, of course, prior to COVID, a lot of the initiatives like Aadhaar, Jan Dhan, and all of that essentially laid the foundation or the backbone for this to happen, number one. Number two is essentially for businesses. Digital technology, especially during COVID times, helped businesses to, in a way, ensure that their businesses moved online. And with the help of technology, they could reach out to millions of consumers in the hinterland of India, or in Bharat, as I would say. So that essentially, to me, is the big thing. And so all the startups that you are seeing today, all the new age businesses that you're seeing today, which are getting listed and are going public, are doing IPOs, have essentially, I think, have benefited quite significantly because of COVID. The third, of course, is consumers. That, of course, earlier we thought that there was probably a more gradual pace of adopting technology. With COVID, we as individuals pretty much compelled to adopt technology. Technology adoption became an imperative. And I think what this has done is it has changed the landscape. It has changed the business landscape. It has changed the investment landscape. So right from booking our train tickets, booking our airline tickets, doing our hotel bookings, or even ordering our groceries, ordering our medicines, all of these things essentially has gone increasingly digital. And that, to me, is very, very powerful. So I think over the last 5 to 6 years, there have been many things which have triggered this change. But to me, the single biggest thing which COVID has done is basically adoption of digital technology. And this is across the board, by the governments, by businesses and enterprises, and by individuals and consumers.
Thank you. I think, it has been illustrated as a huge opportunity which has been leveraged by the government, by business, and by consumers. And in a way, I think it was a behavioral change which overcame a fear factor or a reluctance factor or inertia factor.
Yes,
Thank you.
and just imagine how we would have all lived through COVID without technology.
Absolutely. Absolutely. I move on to the next question. Are Indian IPOs overpriced? Why are the markets zooming while the economy is not?
Well, that's a very, very interesting question. And, it's pretty much like pricing of IPOs is pretty much, I'd say it's not just a science, but I'd say that it's pretty much the eye of the beholder. To say that every IPO is overpriced, I'm not quite sure whether that's in a way whether that's factually correct. There are businesses which essentially are businesses which are very strong. They have strong moats and are in a way going to pretty much define the decade ahead. And then there are going to be companies which are IPOing themselves, which are going to be very also ran kind of businesses. And clearly, in a way, the markets in a collective manner has been discerning enough to differentiate between IPOs of companies which are going to remain hugely relevant and maybe define and redefine the times ahead, and if the pricing is right. And clearly the markets are willing to pay a premium for businesses in a way which are going to define the times ahead. So I'd say that yes, in general, IPOs look to be overpriced. They seem to be, because when we apply conventional parameters of price to book, P multiples, they do look overpriced. But keep in mind that these are very different kinds of businesses. We have been used to looking at businesses growing at a given pace and generating profits. Versus that, how do you look at businesses which are growing, are reinvesting the cash flows in acquiring customers, building scale, and delivering value to an increasingly larger pool of consumers, and therefore are not able to show accounting profits. And we need to be able to understand that difference. So I'd say that the old age businesses, in a way, invested through the balance sheet by creating capacity. The new age businesses are investing through their income statement or through their profit and loss accounts to acquire customers. That's the difference. So we need to probably look at some of these businesses in a very different way. But coming back to the topic of are IPOs overpriced? Well, that's the nature of the beast. That's the nature of the markets, that we are in a market which essentially has kind of come up quite significantly from the lows of the COVID, and a very vibrant market in a way inevitably results in a very vibrant IPO market. And you will see excesses here. Bull markets and bear markets create excesses. So what you're going to see is that, yes, some of the IPOs are overpriced, but do not paint everything with the same brush. Be very, very company specific. We need to essentially evaluate every business on its own merit and see what this business could look like in the next 5 to 10 years, and then be able to ascribe a value to that.
Thank you very much. I think that is very insightful when compared to the WhatsApp Nyan that keeps passing on. 3 points there. One is the willingness to pay a premium for the future, for instance, for acquiring new customers. And the other is about the comeback from the COVID, which has also kind of boosted the prices up. I move to the last question in this, and perhaps this has already been responded to, but I'm just looking at whether we can have a bit more. We have referred to game changers in the title. Is it the 3D or is it something else?
No, it's pretty much the 3Ds. Clearly, the 3Ds are going to be very, very important pillars of India's investment landscape. And I clearly believe that businesses which orient themselves around 3 things, which is, one is, when I say demographics, it's about leveraging India's long-term potential as a huge mass of consumers to kind of have businesses which become relevant to more than 1 billion consumers. The second, of course, is digitization. And when I say digitization, it's not just digitalization, but it's also technology. And clearly, this is touching every sphere of us, not just in terms of our day-to-day consumption, not just in terms of our discretionary spending. It's in terms of our healthcare needs, in terms of our education needs. We have to keep in mind that technology is ensuring that at some day, when we have even higher penetration of data and even more high quality 5G coming in, this has the potential to ensure that healthcare and education reaches every home of the country, reaches right at the bottom of the pyramid, and has the potential to truly transform India's human resources and make India even a more solid economy. It's also about deep tech. This is not just about applying technology to some of the businesses, but it's also about creating technology, which really helps. And then on top of that, you have businesses which are going to be able to use artificial intelligence, machine learning to create solutions for consumers, to create solutions for businesses. When I talk about digitalization and technology, we're also talking about the SaaS-oriented businesses where software as a service. We have today, the global spending on IT services and India's exports of IT services is about $200 billion. That's phenomenal. That's larger than the overall exports of crude oil by Saudi Arabia, one of the world's largest producers of oil. So India's IT services is bigger than that. Now, India is now taking the next step where we can essentially use software as a service to basically increase our share of the world spending on technology. We recently saw that through the listing of Freshworks on NASDAQ, where Freshworks has become a hugely valued company on the NASDAQ, which is a company, a homegrown company. And you're going to see now several tens and dozens of Indian SaaS startups basically building up scale and growing. So that's the second big area. And then when I say decarbonization, the opportunities again are huge. We've been used to basically seeing how we can generate power from hydro, from solar, from wind. And now, of course, the next big thing is hydrogen. And you're going to see again a lot of technologies evolve around helping India becoming a carbon-free, a carbon-neutral kind of an economy. And there are going to be several businesses there. And in addition to that, I talked about financials, where there are areas around fintechs, credit, life insurance, general insurance, health insurance, mutual funds, investing into India, investing into international markets, REITs, which is real estate investment trusts. Then, of course, the investment trusts, which have come up in, say, areas like power, in power transmission. So you're going to see, a whole diverse set of opportunities, a bunch of opportunities, which essentially are going to be relevant and attractive. So I clearly believe that the 3 Ds are a starting point, but when we get down and delve deeper into each of the Ds, we will see several themes, several sectors, several subsectors, variety of businesses, businesses which are leveraged to India's growth potential, the domestic growth potential, which are leveraged to India's export potential, India becoming a huge player in the global supply chain. We have seen this in specialty chemicals. We have seen this in textiles. We have seen this in pharmaceuticals. Remember, in the COVID times, India was essentially called the pharmacy to the world. So these are the kind of opportunities which are emerging. And if you look at, say, for example, pharmaceuticals, it's about India consumption. It's also about India becoming an exporter, where India can provide affordable medicines, affordable drugs to rest of the world. That itself is a huge kind of an opportunity. I mean, we've seen recently the world of pharmacy. You're going to see an IPO come from, say, PharmEasy. That IPO is going to come in soon. And if you look at that kind of an opportunity, currently India's market is $40 billion of medicines getting consumed. In the next 10 years, that's estimated to be $120 billion. That itself is going to create a huge amount of opportunity. And this is going to be an opportunity not just for the online players, it's going to be an opportunity for our domestic pharmaceutical companies in terms of manufacturing. And all of that, and all this is getting powered even by the government's own PLI schemes, production linked incentive schemes, where investments, there is going to be where there are production linked incentives for the manufacturing sectors. So I clearly believe that, the vast amount of opportunities are there. Agriculture itself is going to create huge amount of opportunities as there is going to be increasing mechanization, the demand for tractors, the demand for other farm equipment, the demand for high quality seeds, the demand for high quality agrochemicals, the demand for storage for farmers, the demand for essentially helping farmers to basically sell. So therefore supply chains, cold chains. So again, farm to fork itself is a huge opportunity where businesses which can become part of the value chain from essentially the farm to every home. I clearly believe that itself will create a lot of opportunities, ready to eat segments, ready to cook segments. These are again the kind of businesses which have huge potential. And these are all part of India's socio-economic transformation, where earlier the women would sit back at homes and cook. Now women are also joining the main force. And therefore there's going to be less amount of time spent in kitchens, which means the demand for packaged foods, the demand for branded foods. So essentially the whole tendency to buy loose, buy unbranded is shifting to buying branded from organized players. So the food economy itself is going to be huge. Let us look at India, a $3 trillion economy, 60-65% is consumer driven. Of that, 60 to 65% is led by spending on food. So that itself is going to create a huge amount of opportunity. So after food is going to be things like fashion. It's going to be things like fun. These are again going to be huge amount of businesses which will essentially grow quite significantly as India grows, as India moves ahead in its economic cycle.
I think that is an excellent elaboration of the game changers. And while doing so, I think the main focus has been the socio-economic transformation for growth, driven by the 3Ds and the financial sector. And I think you've covered a good number of sectors, at least about 10 or 12 sectors which you've mentioned, where this change is going to take place. And I think given more time, you would have mentioned more sectors. So thank you very much for that response. With this, we come to the end of this cluster. I hand it over to Professor Sudhakar for the next cluster.
Thank you. Thank you so much.
Thank you. Mr. Nilesh, I thought listening to your explanation and everything that's going on in terms of the wide coverage, it's been quite extensive actually. I thought I will have a rapid fire kind of session for the remaining questions. But I just realized in the last response that you've already been firing like a automated machine gun. So there's no room for even a rapid fire now. So what I'll do is I will ask bit questions, but I don't know, you will respond again in a elaborated manner. I believe it requires some elaborate answers as well, but try your best, sir. Question number one, this is about brass tacks, this is about opportunities and specific questions. How does one identify best investment options available? There are 3 sub-points in this. How does one identify multi-bagger stocks? 1. Second, stocks which give a return of 20%. C, best stocks for long term now.
Okay. So there are 2 parts to this, and probably I think all the 3 sub-points I'll probably try and kind of provide a more cohesive kind of an answer. One is to basically look at what's the kind of time frame. Multi-baggers are great, but multi-baggers are more relevant for a more short to medium term horizon. When you increase the horizon and you say, I want multi-baggers over the next 10 years, the next 20 years, then you probably call them as compounders. Because when businesses compound at a steady state over the long term, then they themselves become multi-baggers. So I think it's very, very important first is to identify the kind of time frame that you have. And when you have a longer term time frame, first of all, the first important question to ask is, will this remain a survivor? Is this business going to basically survive especially the wave and the onslaught of disruption, which is getting unleashed by technology itself. So keep in mind, technology is both a Brahma as well as a Shiva. It's a creator, it's a destroyer. And in between, you have to find whether this business is a Vishnu, which means a preserver. And when a business survives, preserves itself, and it keeps growing at a steady pace, it becomes a compounder. And when it is a compounder over 10 years, 20 years, it becomes a multi-bagger. So when a business compounds, say at 25% over 10 years, it actually becomes a 10x. And when it compounds for another 10 years after the first 10 years at the same pace, it becomes 100x. So a 25% compounding for 20 years delivers you 100x. So I think the moot point is to understand whether you want a compounder over 20 years or you want a multi-bagger over the short term. So that's I think the key. The two is that how do you look for this? Essentially is very simple, but simple things at times are difficult. Is to see the growth potential, the market opportunity which a business is addressing. Is that opportunity large? Is that basically a market which is underserved? And two is, does the management of this business have the ambition, the agility, and the ability to make the most of that opportunity? And I think if you get answers to these two, I probably think you have a long-term compounder or a multi-bagger in your lap.
Great. I think the time frame is the key here when you look at these stocks and investment options and whether these businesses can survive the onslaught of technology. And the analogy that you are given in terms of technology being both Brahma and Shiva has actually provided the answer. So you look for compounders or you look for short-term investment options. That is, one has to refer at the initial stage itself. Thank you very much for that response. Second quick question, sir, is your comment on REITs as an investment option.
Well, it's one more investment opportunity. And one should essentially look at this more as a kind of a fixed income opportunity, a relatively high yield investment opportunity. Early days for our REITs market, still very kind of small, very shallow market. But my sense is over the next 5 to 10 years, this will become a much, much bigger, a much more diverse kind of an opportunity with a lot of depth in it. So of course, it's a space to be watched. And of course, when possible, worth participating as well.
Oh, great. That's a very positive outlook. 5 to 7 years from now, it's going to be a big opportunity. So thank you. Next question. How do you see the entertainment industry growing and as an investment option for us, given the OTT surge?
So entertainment per se, of course, is huge in India. And we all know in India, of course, the two biggest sources of entertainment, of course, are Bollywood and cricket. These two are essentially the big sources of entertainment. But having said that, we don't have dedicated OTT players because the entire entertainment is shifting towards OTT. And therefore, there's a huge amount of disruption which the online video players are doing. So we don't have enough of a choice right now. But yes, the opportunity is big, but I think there is not enough way to participate in that opportunity.
Very good. I think that's a very realistic kind of answer for us. Opportunity is big, but there are no venues or no to participate. The last question in this cluster I will take, I'm actually fast pacing it, is do you think the investments will now move from, say, equity and mutual funds to like crypto and NFTs?
No, not at all. Clearly, I think, fixed income and equities are the oldest asset class. They've been around now for years, decades, and in some markets and some parts of the world for maybe a century. So clearly, there is no risk. As long as there are businesses, then there is basically going to be equities and fixed income. So as long as there are businesses, there is no option out of equities and all. At best, the others can become asset classes. The way gold is an asset class, the way real estate has been asset class, there would be several other asset classes, but I still believe that equities and fixed income will remain the biggest asset classes for the foreseeable future.
Fantastic. There's a great clarity on that, especially in the current times when we talk about crypto and we get quite a bit. One last question before I hand it over to Professor Prasad, just in case he has to pick up one more question from the next cluster. I'm just bundling it. This is, will the proposed regulations of RBI on cryptocurrency improve investment market in India?
I believe that if crypto has to become an asset class, and if there is to be a very larger participation, it needs to be regulated. Anything which is not regulated or is unlawful is not healthy for the economy. It is not healthy for savers. It's not healthy for investors. It's not healthy for the economy. It's not healthy for the country as a whole. So honestly, any regulations on cryptos is welcome, and it must be done sooner, the better it is.
Great. I think that's a fantastic piece of clarity once again on this. I'll now hand it over to Professor Prasad because we are already hitting 8:36 p.m. I have sought for 1 hour and we are already through with 1 hour, but looks like our appetite is not going down. We have a lot more questions, but then I will leave it to you. Professor Prasad, maybe you can pick up 1 or 2 questions and then I'll come back.
Certainly. I think some part of the methods has already been discussed. There are 2 aspects to it which are coming up in this cluster. One is about how does one assess risk, and the other is about timing.
Risk, essentially assessing risk is the most important part of it. Because I said, to me, risk is nothing but permanent loss of capital or damage of capital. And I think it's important to essentially, and the ability to assess risk also comes in with experience. I'd say that investing is not just a science, but investing is both a science and art. And you need to be able to ask the most relevant questions in terms of that, questions around the business, in terms of that, how vulnerable is the business? What is essentially the runway of growth for the business? And what's essentially the vulnerability of this business to regulation, to technology, or to changing cultural habits or culture, or a changing and an evolving consumer. So these are some of the questions which one needs to be able to answer. The second risk is always about management and corporate governance. We see businesses essentially which get governed very well and businesses which get misgoverned. So the second risk is always around management quality and governance. The third risk essentially is always around the balance sheet. Is this a leveraged balance sheet, or is this a very capital efficient kind of a very cash rich balance sheet? Are there pockets deep enough for the business to essentially grow and be able to reinvest? And the last risk essentially is always around valuations. Are you overpaying or not? And that comes down to timing. That what it is, and the best answer to that is to be able to form a view of the business, have a value to the business, and see what is the price you're paying for that. I think the best way to handle risk is to understand the difference between what is the value of the business and what is the price you're paying for this business. I think when you are able to understand this difference, I think in a way you are being able to assess the risk and being able to price the risk.
Thank you. I think that's a very, for the commoner, it's a very, very simple way of understanding what is the value of the business versus what we are paying for the business, and it can be understood by everyone. The other dimension of this question was about the timing.
Yeah. So there is honestly nothing like the right timing. For anything good, as they say, there is no right timing. Okay. Every time is a good time. My only thing is that when you are a bottom-up investor, when you are investing into an individual stock or an individual company, you have to look at it on the merits of that investment, that specific investment. So you can think macro, but you need to act micro. That is very, very important. Finally, markets will go up, markets will go down. There will be volatility. There will be events which will shake up the market, which will shake up your confidence. at the end of it, it's only your time in the market which will help you and not timing the market. It is only the fundamentals of that individual investment, the merits of that individual investment, which will matter. So do your homework well, carry your conviction, and that will able to basically help you to essentially ensure that your time in this market is very fruitful and it is basically a fun ride and not a torturous ride.
I think that is also a very wonderful way of communicating timing versus time. I think that is also very easily understandable. Also about thinking macro, acting micro, and focusing on the fundamentals. Thank you very much for the very insightful response to the question. I hand it back to Professor Sudhakar Rao.
Oh, thank you very much. One small question, Mr. Nilesh. Somebody is using the Arima model, and how good is it in predicting the price of stock? I know you already mentioned that investment is not just science, but it's also science plus art. But any response to this Arima model specifically?
Well, all I can just say is that, in fact, yesterday I read a tweet by Nitin Kamath, the founder of Zerodha. And he said that we don't use artificial intelligence. And according to him, no brokerage in the country uses artificial intelligence. So as I said is that, and that's why I come to it, that investing is not just a science, it's an art. And of course, the AI part of it, predictive models and all of that, in a way, label it as a science, but things like behavior essentially come from the art part of it, which I think predictive models cannot help you. How do you capture the socio-economic transformation that is happening in India? So to that extent, I clearly believe that, you cannot just entirely rely on predictive models for prices. Again, as I said, price and value are two different things. You can maybe try and predict the price, but you need to be able to comprehend and assess and ascertain the value of a business, the value of a security, the value of an investment.
Excellent. Thank you very much. You're reinforcing the same thought. What is the art part of investment and what is the science part of investment and what is the specific role played by each one in probably making up those decisions for investment. Thank you very much. If I may be allowed to ask one last question, generally they say one for the road, that is, how do we foresee the hospitality industry?
Very, very interesting, very exciting, the hospitality industry. And clearly, of course, keep in mind that there's the conventional hospitality industry, which is asset-led, which means you construct hotels, you construct resorts, you own them, you operate them. So that's great, but keep in mind that it is a very capital-intensive industry. And over a period of time, markets have tended to, on a sustainable basis, not reward capital-intensive businesses as much. They become more or less cyclical investments or cyclical trades. In addition to that, there is the way to look at it is basically to look at business hospitality industry, which is not asset-led. So you have businesses which run timeshares. You have the OYOs and the Airbnb kind of models. And then of course you can play hospitality through the online booking companies. We have some of these companies listed in the United States. There are some companies which have just got listed and some more are going to go IPO. So hospitality as a space, very interesting. Capital intensive businesses will always continuously get disrupted. So within hospitality, spot the businesses which are using technology to reach out to the consumer, retain the consumer. Those are the businesses which can leverage to make the most of this high potential industry of hospitality in India.
Fantastic. That's again slaying in terms of your response. Awesome. I think hospitality, which is asset-light, hospitality, which is new age, hospitality that retains customer base is what you advocate for. Thank you so much. I think it's been a hugely insightful session. It ran like, something like somebody cutting butter. So it ran like that. It's fantastic. And we couldn't have asked for a better person than you speaking on this very, very essential topic of investment in India, why India is one of the best destinations for investment in the world, and how India is poised to actually grow. You have envisioned that from the current $2.5 trillion economy, it is poised to move towards $5 trillion economy, and then about $10 trillion economy. And the per capita income of $2K currently, now moving to $10K. And you have actually compared this with what has happened in China from 1975 onwards towards very, very recently, 2015, because of the way they have put forward their people or their demographic advantage, and how they have brought in massive reforms and brought in investments, not just from domestic investments, but also the foreign investments. And also what has happened to the United States post-World War II, that is 1950 till 1990 and even now. The same thing is going to happen to India, and therefore there is a lot of promise. So this envisioning map that you have laid out is also supported by a very clear executable kind of roadmap that you have talked about in 3Ds in terms of harnessing the demographic advantage that we have, and also in terms of adopting technology, which is actually fast-pacing, a huge advancement in terms of pushing the businesses forward. And also the third one, the latest buzz is decarbonizing, carbon neutral or carbon less kind of economies. And that itself is offering several opportunities for people in India. And another significant factor that you mentioned is that we manage this growth at this while also balancing the income inequality when we move from agriculture to manufacturing by leveraging world-class infrastructure that we need to invest in and build very, very quickly. I think all in all, both in terms of depth and in terms of the width and the coverage, I think this particular masterclass on investing in India and India as a destination, very attractive destination that is, has come out extremely well, and I'm extremely thankful to you. Not only myself, everybody around the screen seemed to be hugely delighted by listening to you, and very sincerely from all of us at ICFAI, we are not only proud of you, but we are extremely thankful to you for sparing this time and delivering these insightful responses and answers and providing solutions to some of the confusing questions that we have on. These are not easy topics. So on these topics, I think it has been wonderful. It's a great learning opportunity to myself to start with, and I'm sure for many others as well. We look forward to interacting with you once again. We look forward to writing to you. We will share the summary of this session with you and also the video. And probably if you have more questions, we'll share it with you on email, and would like to stay connected to you. You are our proud alumnus and also one of India's top professionals in asset management and corporate finance. Salute to you. Thank you very much.
Thank you so much. I'm honestly honored, humbled to be here and be part of this session. I think there were some very, very interesting questions, very thought-provoking questions. And I hope I could basically articulate my viewpoint. I hope the session was very informative and interesting. And so thank you so much. And on the note that good luck with all your investments in a new India. May all of us become hugely successful investors. Thank you so much. Good luck to all of you and to your families.
Thank you. Thank you very much, sir. And I also want to, without forgetting, thank you, Dr. Bhaskar Garu, for coordinating and requesting Mr. Nilesh Shah to join us for this session. Mr. Nilesh Shah is a very, very popular figure in this country, and it is not very difficult to actually seek his time. You have done that effortlessly, and I'm sure that builds the rapport that you have with him. You're also a co-alumnus of Irma. I'm sure that's the connect. And he is the alumnus of ICFAI. That's another connect. And so we've been lucky today. Thank you so much. So ladies and gentlemen, and all the members who have participated, we'll see you again next Friday, same time at 7:30 p.m. with yet another distinguished guest, with yet another interesting topic that matters this country, not just in terms of business, but also in terms of society, how we transform ourselves and build pathways to be part of the growth story called India, and also the growth story that is largely now in Bharat. So thank you, ladies and gentlemen. See you next week, same time. Have a good evening.